Hello everyone, welcome back to the Monopolistic Investor, and in today's video we'll go over InPost's Q1 2025 earnings presentation, and we'll say something interesting about them. We'll also be taking a look at my portfolio and how it has performed over the year-to-date period and 3 months, and how important it is to keep a long-term mindset, to not be scared during times of when your returns look like this. That's why, okay everyone, so let's start off with the presentation. InPost is a company that is from Poland, but it is listed on the Amsterdam Stock Exchange in the Netherlands, and they offer those automatic parcel machines where a user comes up to them to receive his parcel at any given moment in time. So the courier or the postman goes to the machine and puts your parcel in it in order for it to wait for you. And if you don't get it in time, it gets sent back to the sender. So with that mindset, we can turn over to the presentation, because I think some of you might not exactly know what this company is doing. So we can see that 56% of their revenue is from Poland, and the revenue increased by 22% year over year, and that is excluding their foreign exchange impact. And also an important thing we need to look at here is their volume growth, because obviously this is a company which is based off infrastructure. So we are looking at the volume growth, and we can see it's 12% year over year growth, and it's also really a good impact in their EBITDA margin. We can see that it improved by 50 basis points year over year, and it means that the profitability is improved over all of their segments. And the recent acquisition of Yodel strengthens their market share in the UK. As you can see, for them it's 8%. That is actually, really important for me. As you all know, I'm a monopolistic investor, and it's not just a name. I'm looking for companies which have a huge market share in their markets. So we can see that they have many parcel machines in the UK as well, and so that is really impressive for me. So yes, the majority of their parcel machines may be in Poland, but that doesn't mean they are limited to that. 12.1 thousand automatic parcel machines year over year growth. So all of that, is really, really impressive. Personally, I do want to place an automatic parcel machine on a plot of land I plan to buy at some point, in order to generate some passive income at some point. And the important thing is they don't only do APMs, they also do pick up drop off points. So small corner shops, you might have 7-Eleven in the US, we have Żabka here, or other ones. So you can pick up and drop off your parcels right there, which is very handy for consumers. So they are optimizing their pickup and drop-up points in France. And as a result, the number of pickup and drop-off points remains stable year over year. And that aligns with their goals, So overall, they have 33,000 PUDO, that is pickup drop-off point. So that is 5% year over year, and 50,000 APMs, 32% year over year growth. So now we can see that their total e-commerce market volume growth year over year compared to InPost. In Poland, we can see InPost is growing faster than the PL market. in the Eurozone, so you have France, Spain, Portugal, Belgium, Netherlands, Luxembourg, and Italy. We can see that Eurozone InPost is actually growing a little bit slower than the InPost business to consumer. So when businesses buy out an option for their customers to have cheaper shipping, they collaborate with many different providers, for example with Vinted. As for the United Kingdom, while their growth might be slowing, it's still significant, double digits. Poland update, so further customer and merchant loyalization. This isn't only a company which is growing faster or slower because of some APM growth or two-door. It isn't the only thing that they are doing. What they are also doing is InPost Pay. It's a special service which is just genius in my opinion because of its sheer simplicity. Instead of you putting in your credit card number all the time on different websites, you just have this small button called InPost Pay, and it redirects you to the InPost app on your smartphone, and so you get logged into their ecosystem, but you get everything in one place, so you can see your items in your cart in InPost app, and also you can pre-select the nearest parcel machine near your house, and also you have your debit card information right in the app, so it's all very handy. So it's not something that is really a bad thing. It's a really good thing. 8.3 million plus registered users, and they got an award from the Global Finance Innovators 2025 for a good reason. So now let's take a look. Before that, loyal users are people who we have loyal users preferring InPost and shop across multiple merchants. First of all, APM users year over year, so no new people, have grown by 7%. Great. We can see that many people are also using the soft version, which is soft is that, soft user received at least one APM parcel within last month. Super heavy user is the gray one, and that is someone who received at least 40 APM parcels. I think this growth is mainly due to people like on OLX or Vinted. That is possible. That is a great thing. And so let's continue on to their business update on their international segment. Right now they have divided their presentation into the Eurozone, Poland, and UK section. So now let's see the growth in their number of endpoints. So we can see that many new points are the APM machines and not pickup drop-off, which is far more convenient, the APM machine, than the PUDO points, because it's available 24/7, while those may be stores which can be closed on weekends. So that is great. And increasing population coverage, because 7 minutes to the points, 47% in Iberia, 34% in France, 40% in Italy. Those people are within 7 minutes of a point that InPost owns. Belgium and Luxembourg have a bit smaller percentages, as well as Netherlands, we actually have 16, so Belgium and Luxembourg has around 22. Parcels eventually will convert to APMs, because people who like the fact that you have this pickup drop-off point, eventually it becomes a bit inconvenient for them, because they want to get parcels. For example, on the weekend because they order something for a surprise birthday party for someone. And so eventually they'll have more growth in the company in the APM rather than pick up drop off. That's why you can see stagnation in this segment. And that isn't bad. That is good actually. It's good that this is growing, the APM machines. We can see that business to consumer is growing pretty well, I must tell you. 65% of business to consumer parcels were delivered in Q1 2025. And it means that it increased by 3.8%. So we can see that the majority, well, maybe not the majority of their operation, a bit smaller, but we can see that their business to consumer section is growing rapidly. That is a very good thing because businesses are far more reliable than consumers. So growing customer base, of course. In 2 new markets we have the app, and now they have around 29% of the ex-border market volume share in Eurozone e-commerce total volumes. That is what they say, and that is based on FEG consulting data. And they have around 7 to 10% ex-border volume. What does it mean ex-border? Does it mean without borders? Well, I think, or maybe through the borders. Yes, I think that it means through the borders. So, total volumes, that is great. That is truly incredible how they are achieving this kind of growth. So they are also highlighting the fact that they have record high year-over-year those lockers growth expansion in the UK. And so 75% population coverage in 3 top cities, and that is London, Birmingham and Manchester, and so they live without 7-minute walking distance. And while that isn't the whole country, it's still around 51% of the population. You can see those 3 cities somewhere here. Important for them to be placed in those strategic locations. So the volume growth, Yodel pro forma, I'm not exactly sure what this means, but I like the fact that it's growing. This is due to their acquisition. UK plus Ireland, so they are expanding their merchant base. So you can see that InPost lockers are clearly marked at the checkout, so people are used to their logo. Zara, Vinted, H&M, Adidas, Shine, Temu, Mango and Gap are all using InPost. InPost UK and Yodel, those are around 760 B2 consumer merchants. And app users, so the people who are downloaded using their app, are ordering 51% more than non-app users. That is great. Now let's take a look at their financials, because that is what's the most important. Here you can see the difference quarter over quarter, for individual markets. Poland isn't this fastest one, but pretty good as well. While UK and Ireland is the fastest, I think it's due to the acquisition that they have done of that company I mentioned before. Free cash flow per share or overall has decreased 32% for Poland and 70% for us for the whole. That isn't the most positive thing, but I think it's due to their capex. Look at their capex. It has increased by 38% year over year. 38% of capex expansion. And it's still only 11% of their total revenue that they have earned. That is really good. It's like an Amazon in the early stages. Just wait. And they are also partnering up with Amazon, so don't worry. So in Poland, they have solid volume growth despite the high base from Q1 2024, with the strongest increase from small, medium, and enterprises, 18% year over year. Revenue growth is faster than volume on the back of low single-digit repricing in APMs, slightly offset by volume mix. Pretty complex words here, but what this means is just the revenue growth is faster than the volume because of lower repricing in APMs. Maybe it's still not clear. But they are continually improving their profitability in the Eurozone, and they have higher APM adoption. Of course, that is great. Their volume growth is surpassing the e-commerce market. That is driven by another quarter of strong growth in the business-to-consumer segment, plus 29% year over year. The explosion of companies such as Temu and Vinted, I think, can be connected to that. Yes, the UK growth, yes, it's on track to deliver on their guidance. That is positive. So, we can see that their operating earnings before interest, taxes, depreciation, and amortization, it has grown by 22.6%. While some people don't like EBIT or EBITDA, well, it is some measure of a financial performance of a company, so don't neglect it completely. While their net profit from those operations is a bit smaller, remember they are spending on capex, so don't worry about that. And their free cash flow can be impacted by the payment calendar. I won't go into that. But if we take a look at their financial discipline, they are only at a 1.9 net leverage. That is positive. While it changed a bit into the negative, it went downwards. Slight deleveraging, even though they bought Yodel in Q1 of 2025, the UK company. And so that is positive, their financial health. So now we can see their outlook. They expect InPost to increase market share in all markets, and they expect year-over-year group volume in the high 20s level. So they are expecting the overall volume to go up significantly because of more APMs, and they expect more EBITDA growth. They plan to accelerate over 14,000 APMs across all markets, so around 3,000 in Poland, and that is for full year 2025 or fiscal. I always get them mixed up because it's a bit similar. But capex of around 1.8 billion PLN, with around 60% allocated for APM production deployment. So you can see that most of their capital expenditures goes into the actual manufacturing of the APM and not the servicing of it. But it's still a good thing. And that is all for their section. I will now go to my app to just show you visually, I think, how their financial situation looks like. Do I have it added here? No. Let me just search up it. And I have it here. It's now added to my watch list. Where is it? InPost. Here it is. So now let's just open it. It should load in a few seconds. Okay, so we can see that here is InPost's financial analysis. Let me just zoom out a bit. So we can see that they have a negative net cash and a positive net equity, but that is understandable due to the recent acquisition, but you can see it's pretty good, I must tell you. Versus other companies, they are really well positioned with their efficiency metrics. We can see that only Tion, Exo, and VKL and Arcade are some meaningful threats, if at all, to there. While not all of those companies may be exact, competitors to them, it just shows you that in terms of the market as a whole, some approximate view is positive with 12% market share. As for the valuation of that stock, I get the data for them in PLN, and the stock price is reflected in euros. So in order for me to get because this is shown in the PLNs, of course, not in euros. So if I now want to account for some growth, they are looking at some 20%. Well, let's just apply. Maybe let's go a bit. How do you say it? Conservative. Yes, so we will account for 10% growth. Remember, this is supposed to be PLN. So 331 PLN. And that is 78.25 euros. Right now, this company is trading at 15.18. So we can see a really strong upside of something like 3 or even 4 times. That's positive. And in terms of that into USD, because maybe some of you like seeing the USD format, that is 87.69. That is positive, and for the Graham valuation, remember this is PLN, so around the same amount that I have shown. So that is a very positive aspect. While I don't own InPost right now, I'm looking to add to them at some point in my investment journey. I will let you know all the details. But I really like the fact that they are profitable, they are growing rapidly, and that they are from Poland, of course, because I'm a patriot. Okay, so now let's take a look at my portfolio as a whole and see what happened during the past few weeks, days, and what is happening to the market right now. So, as you all know, in April 2nd, we had a bit of a, you can say, unexpected announcement of tariffs. The market reacted really negatively, going down something like 10% in just a few days. I think it was 2 or 3, something like that. Look at this, 10% minus 10%, maybe more, maybe 6 days. And so it went up, then down, because still Trump showed some uncertainty and investors were, quote, concerned, end quote, because investors, or should I say the so-called investors, are always looking at the short-term movements. If you don't get what I'm saying, I'm just saying that many people have a short-term mindset and they aren't investors but pure speculants. So I'm not saying I'm a professional investor, no. I'm showing all my losses. Anyone can have losses or gains, but for some people, it's not for all people to have the nerves to hold even in this moment. So you can see I made some small additions to the portfolio. That was around 30 euros added here. You can see these net deposits have changed at around 30 euros. And it still kept going down. But it's important to hold even at this moment, because I still had my positions here, and the next thing I saw was the market going up again. So I bought a bit of Uber here, I think that was it, and then the market reacted more positively. And while I'm still down over the course of 3 months, so from February I'm on the negative. Over the past year I'm significantly positive. Now, not looking at what happened here, from the 20th of February we were down, and while I still don't have the same amount as I had then, all time I'm up this amount, around 12%. And the companies that I own are high quality, monopolistic, financially pretty stable companies. Companies such as Duolingo, Adobe, Altria, ASML, Starbucks. Mondelez may not have the best financials, but I bought them for the brand. So you can see I own many companies, but not too many, because I'm not doing diversification. So what I'm thinking about buying soon is Mondelez, Adobe, Starbucks, ASML, Alphabet, or Uber. Uber is actually a very high quality company, I'm pretty sure it will hit soon $100, but we'll see. I'm a long-term investor, so I will keep holding. That's a good lesson for me, I think that Uber, ASML, or Google are really good bets because of their pure monopolistic position. Google is slightly down due to the announcement by Apple that they have plans to make an AI browser. Let me just tell you, Google is still being used, and things such as Circle to search, or Google Lens. You have YouTube, you have YouTube Music Premium, you have Waymo. Many people forget about those positive aspects of Google, and so they sell down the stock. While I think it's worth much more than it's currently worth in the minds of those so-called investors. If you just want the approximate valuation, even accounting for 4.5% growth, Google is still undervalued, with their shares trading at $164. So you can see my view on Google and my portfolio. That will be all for the video. Thank you very much for watching. See you all later. Goodbye.